Good afternoon to our Livewire audience. This afternoon I'm joined by Michael Houghton, the Chairman of the Lucerne Alternative Investments Fund. At Lucerne we believe that investors' capital is best aligned to independent fund managers, and at our core we partner our investors' capital with both domestic fund managers and those abroad.
Hi Anthony.
Michael.
Given the extended lockdowns in Melbourne and Sydney, there's still a very rosy outlook for what's going to happen once those lockdowns are lifted, particularly around supply chains, asset prices and employment. What's Lucerne's view on that?
It's a great question, Michael. I think it's on everybody's lips at the moment that once we actually do come out of lockdown, well, what does the world look like? And in some respects, it's quite ironic that whilst we're in the midst of lockdown, particularly last year in Melbourne, we both experienced that markets were booming and everybody thought, how good was this, particularly with the amount of stimulus that was being pumped into the economies around the world by central banks. The ironic thing now is if you look at consumer confidence, particularly on a global basis across China, across the US, across Europe and across Asia Pacific, consumer confidence is sliding. Yet if we look to the Northern Hemisphere, most of those economies are now open and people are freely travelling around Europe and the US. And so I find us in quite an interesting, inflection point that as we move out of lockdown, will businesses be able to, get back to where they were previously? And that's one thing that governments are obviously banking on and hoping will be the case. I think from a lifestyle perspective, we're going to see that pick up again in hospitality. We saw that last time in tourism, that as soon as that we were released from our cages, so to speak, we were able to freely travel, we were able to go to restaurants, you had to make bookings. But if we think about businesses as a whole, well, where we've had this safety net over the last 18 months that governments have more or less had to provide to businesses out there and large corporates, once those safety nets are removed, well, where are we positioned? And that is the scary thought, and that's probably why we're seeing that waning in consumer confidence. There's some other scary statistics out there at the moment. Only last Monday, Livewire posted in their daily incredible stats that if you look at the US economy as a whole, so the US share market is now 2.1 times larger than the US economy. For a relevance point or a point of reference, if you go back to 2009 pre-GFC, the market was 1.3 times the size of the US economy. And if we go back to the dot-com boom and crash, it was 1.7 times. So you use that statistic at the moment, things are quite hot. We are in a bubble. Many are saying that around the world at the moment. So we're approaching the world, quite cautiously at the moment as a result.
Yeah. And yet we've got this issue with inflation and the debate that's raging around both central banks and through investors as well. Is it transitory, something that's just passing, or is it something that we've got to be more concerned about as staying longer term and something that we've got to manage to? And it's interesting that central banks are still behaving as if inflation is not a problem. They're not talking about raising interest rates. They're not talking about trying to manage those inflation targets that they set themselves. And we're seeing inflation, like in Australia, much higher than the band is at the moment, but there doesn't seem to be a lot of concern. And that's something else that we've spoken a lot about too.
Yeah, I think central banks at the moment, they, as you mentioned, inflation's a problem. It's a problem that they're hoping that goes away. And that word of the month at the moment, transitionary, well, it seems to be the word of the month for the last 3 months. And if you think about investors and where they're faced at the moment, 3.8% inflation, cash is paying you 0.5%, and central banks are going to keep interest rates low, as they said, for the next 3 to 5 years potentially. So cash is 0.5%, bonds at best are 2 to 3%, inflation's at 3.8%. So your real return after adjusted for inflation is actually negative at the moment on those defensive assets. And what does that mean? It's forcing investors into a very uncomfortable environment where they're chasing equity market risk in order to maintain lifestyle, particularly for super funds out there. And I guess that sort of brings us on to sort of another important part. So you take that sort of global macro view, well, what do you think that actually means for the economy and financial markets on a go-forward basis?
Yeah, and that is the problem, I think, that we have to discuss and deliberate on around what does happen with supply chains, as you touched on earlier. Prices for goods and services are spiking considerably. The cost of shipping is also up to 10 times higher than it was 12 months ago. There's a lot of other factors that feed into the cost of production of goods and services that are only now starting to get priced in, and I don't think we've seen that impact individuals, consumers, businesses yet. And that's another consideration, that as you or as we start to see that unfold, I think the transitory nature of inflation may very well become more permanent.
Yeah, absolutely. And then the other problem we've got going into, I guess, the winter in the Northern Hemisphere, we'd like to think with vaccination rates that we're not going to see any more lockdowns in the Northern Hemisphere. But then again, if you do have another variant of COVID-19 that's a variant that scientists and experts around the world were unaware of and vaccines aren't counterproductive against that, then there could be another lockdown in Europe and the US. And we hope that's not the case, but that's going to put more further pressure on markets. And we only saw it was Monday this week that the Wall Street giants came out and actually downgraded US equity forecasts and earnings. So I think at the moment the market's gone from being in a very bullish period only 3 months ago, literally, to now everybody's sort of sitting at this inflection point and wondering where to from here. And if you look at the Aussie share market itself, the ASX 200 since September last year has gone up every month. We've had 12 positive months in a row. And the last time we experienced that was in 1943, I believe it was. So it just gives you a real indication of the period that we're in. And you might fast forward 5 years from now and we'll look back and say that was all easy in hindsight. But when you're actually in the midst of where we are at the moment, it's this debate at the moment that we're constantly having with investors. Do we continue to chase more equity market risks to realise returns outside of those lower yielding defensive asset classes, or other ways we can position portfolios at the moment?
You made a comment just then about where to from here, and that does lead into another discussion that's been something that we've certainly talked about at Lucerne, and that is that concept of there is no alternative, or TINA as it's called.
Yeah.
We believe there are alternatives, literally and figuratively. So what sort of alternatives and what options should investors be considering in this market where you feel like you're compelled to follow a direction because that's where everybody is?
Yeah, I think it's pretty unfair to anyone out there named Tina as well, by the way. But look, at the end of the day, as investors, what we're really guilty of doing, and sometimes right, sometimes wrong, is when we think about investing, and if we're in a good position, we think, well, what's worked quite well for us for the last 10 years? Well, I'm just going to repeat that behaviour, particularly if you've had favourable outcomes. But where the market is at the moment, it's in a really different period to what we've experienced historically. If you think about where interest rates are at the moment, they're on the canvas, so they can't go any lower. So whilst you've had interest rates sliding since the GFC, and you might remember the RBA back in 2009 were able to cut the cash rate from 7 to 3% to stimulate growth. We went back up to 5.5%. Now we're effectively at zero. So all those silver bullets that the RBA has had and the Fed Reserve in the US have now been used up. And so what did you see last year when we actually had the pandemic and the market collapse? They had to use their other tool, and that was effectively to print. I mean, 30% of all US dollars were printed last year alone that are now in global market circulation. So where does that take us from a market perspective? Well, if we're concerned that you basically had this artificial stimulus coming into the market from governments can't kick the can down the road forever, which they have been doing for some period of time. But there will come a day of reckoning, and everybody knows the big short out there, and Michael Burry's been pretty outspoken in media of lately, and he's quoted in saying that the longer the bubble goes on, then the harder the fall. And even Buffett, as recently as 2 weeks ago, is now talking about an impending market crash. But then you've got the same problem that I mentioned before. Cash is at 0.5 at best, bonds are at 2 to 3. How does someone still make 5 to 6% on their portfolio but doesn't want to have the exposure to equity market risk? And if market's correct, they could fall sharply. What I think is more likely when considering TINA, the alternative, is if you think about where markets are today and we rewind back to 2015, what you saw over that calendar year was the market actually slid 17.5% from January to December. Not a lot of people talk about that time because everybody feels a crash much harder than a general market sell-off. And so if you think about the market correcting over a period of time, circa 20%, I think that's very realistic. When there is actually mean reversion and an adjustment to earnings, and then investors around the world start looking at markets from a fundamental basis, they'll probably realise that the US trading on 21 times PE is not reasonable anymore. And so over time, investor sentiment just changes. Everybody always talks about what causes the crash. Yes, we saw the pandemic last year. The market was up 7% in January when we knew about COVID. But when the Western world got infected in Italy and US, that's when we saw that market correction. So what's interesting about that is if the market starts to slide and rebase itself down to say 15 to 16 times earnings on a PE basis, which is still around long-term average, if not slightly higher, where do we turn to from employing capital? And we've spoken about this a lot lately at the ISC level. And from our perspective, where we think you can still generate good returns in the market is active management's now as important as ever. And it's the first time last financial year in 5 years where you had active managers actually across the board starting to outperform passive, whereas the 5 years previously before that, just owning the market has served you well. So I guess I'd hand that over to you from a pockets of the market perspective. Where are we looking to allocate capital at the moment, and the different strategies that we're employing within Leif and Lucerne to protect investor portfolios, but still be able to generate meaningful 8 to 12% per annum returns without being beholden to market risk as much.
Yeah. And I think that's an important observation to make, is rather than feel compelled to be allocated a certain way because everybody else is, one of the key things that we discuss and that we discuss either at the investment committee for Leif or with our clients is, what is your return objective? What are the objectives you have for investing, whether that be risk or return, types of assets you're prepared to hold or not hold, etc. And do that discovery process rather than say, well, everybody else is owning something, therefore you should too.
Herd mentality. Yeah.
Exactly.
Yeah.
And from the point of view of the things that we're looking at within the Lucerne Alternative Investments Fund, for example, we have a broad-based approach to the types of investments that we want to hold based on what they do, with the objective of actually achieving what returns we think are viable for the risk that we're prepared to take. And one of the key things that we manage to within the fund is its risk budget, if you like, and also the correlation of those returns to mainstream markets as well as to the assets themselves. And we've been very successful at managing and keeping low correlations across assets as well as to the market. And in fact, our correlation continues to fall over the last 18 months to 2 years.
Yeah, our correlation at the moment across client portfolios is the lowest to the market it's ever been. At the moment, we're running on average at about 0.5, whereas historically we've been as high as 0.8. And so, underlying principle of what we're trying to achieve is, particularly over the next 3 to 5 years, is equity-like returns. And what I mean by that is that when we think about equity-like returns over 100 years, the ASX 200's annualised 7.5 to 8% per annum. So on a look-forward basis, given the market returned just shy of 30% last financial year, we see it very unlikely that you're going to be realising those returns again anytime soon. In fact, there's much greater risk towards the downside than the upside now, in our opinion. So then how do you think about still generating 8 to 10% returns on that? We're taking about half the risk of the market, and we believe at the moment from a portfolio, alignment and composition perspective, generating 8 to 10% per annum whilst taking about half the volatility of the market can still set portfolios up to generate a great return. And how do we do that? I mean, one of the examples we could probably share with the audience is our exposure to long-short equity funds, the 4 different strategies we have in the portfolio at the moment, all quite different in their own right. I think unfairly long-short managers always get bunched as a whole, but we've got 4 different mandates in the portfolio at the moment, and maybe it's worth just talking about the correlation they hold with the market and how we position them.
Yeah, and I think one of the things that we're very conscious of is that grouping that long-short managers can get and be classed as hedge funds. In fact,
Exactly.
we pick the long-short managers that we have because of what they do, the strategies that they employ. One of them's quite well known for its fads, frauds and failures theme, which we are very supportive of because it's quite unique, and the way that they approach that is also very unique. And they've got some very impressive screening techniques and processes. Another one of the long-short strategies that we have is very unique in that it focuses on consumer discretionary as well as US healthcare, and that's again unique. Have those 2 different asset classes or segments of the market managed by the same portfolio manager, but they've brought to that a skill set that is different, and in addition, they manage their risk very stringently. And by doing the way that they manage their risk is by not only how they would put their shorts on or their longs or the types of shares and that they're prepared to own or the themes they want to pursue, but they also always have a risk protection strategy in place so that one of the analogies that we've used, it's like you go out and buy yourself a $100,000 car. You wouldn't drive that around uninsured, not only because of the damage you could do to the car and the cost of repair, but also the cost of the damage you could do to other people.
Correct,
but these funds would typically spend up to 2% of their portfolio on making sure that they've got that protection in place. And the times that we've seen that really come to the fore has been when it's needed to do it. Like an example of that would be for 3 of those funds through the February-March period last year, which you might want to elaborate on.
Yeah, sure. I mean, last year, and Nick Griffin's very well known to Livewire from Munro. Last year we saw their Global Growth Fund. Nick played that theme very well. Moving into March last year, he had protection in the fund. So what that means is that, yes, his equities that he owned obviously fell with the market drawdown last year, but this protection that he had within the fund, you mentioned before, some managers will have a 2% allocation, and just for our audience's benefit, that 2% allocation, when markets do collapse, that 2% can actually go up multiple times. So suddenly a 2% weight in the portfolio in insurance can actually turn into 8 to 10% in a very short period of time as volatility spikes. So it's buying insurance against an asset, just as the world is familiar with doing, and investors are familiar with doing. But quite often when we think about traditional investing, we just think about buying an asset and going up, not actually protecting that asset in case there is a crash, particularly when it comes to share market investing.
So one thing that investors are often guilty of is looking back and making decisions based on what's happened. We think that looking forward is probably more important than looking back. What things are we looking at the moment, or asking investors to consider?
Yeah, well, I think when equity markets have returned 30% for FY 2021, looking forward now more than ever is incredibly important. And look, just to put some statistics around that, we've been in a 12-year bull market since 2009, and I know some people argue against that and say, well, what about last year? Yes, last year we had a pandemic, but we had government step in within days and weeks and ensure that bull market continued by pumping the system with stimulus. So if governments hadn't intervened, you imagine how long we'd still be in that sort of prolonged recovery from COVID. And it's a responsibility of governments to do that when you do have an event that comes out of left field that, you could argue that it wasn't irresponsible Wall Street bankers this time. It was literally a global pandemic, that there has to be a response by governments around the world, and we saw that. However, that has stimulated markets to return, as I said, 30% last financial year, and we're back at record highs at the moment. It is now more important than ever for investors to be taking stock and then thinking, well, where to from here? And unfortunately, we've all been guilty before of saying, well, I bought Commonwealth Bank 10 years ago or 12 years ago at $25, and now it's at $100. I've done fantastically well. So now if I have another liquidity event, I'm just going to go and repeat and buy Commonwealth Bank at $100 today. And who knows, CBA may do very well over the next 3 to 5 years. But I think now more than ever, there is a strong argument to say, well, with the US market at 21 times PE at the moment, are equities the right place to go? With portfolios. Now just look at the greats of the investment world at the moment, your Buffetts and your Dalios out there at the moment. They've been sitting in cash. They've underperformed the market significantly over the last 12 months because they're taking stock, because they're not going to play this game or herd mentality where they get sucked into the market. Just that's where the flow of cash is going at the moment. We actually saw last week that the US Fed Reserve was actually starting to sell some of their equity exposure in the market, because last year, for the first time in a long time, they actually bought the market as a way of showing stimulus measures. So from a look forward perspective and portfolio positioning, we are light on equities at the moment. We are light on long only equities. Where we're looking at portfolios at the moment in the market is positioning them from a perspective of having much lower correlation than where we've been historically, in order to protect downside, but also still be able to make meaningful returns over the medium term.
And that would also be staying out of, when you talk about equities, you're talking about domestic equities, international equities, small cap, large cap, even listed property equities, which are coincidentally 4 of the strongest performing asset classes in the last financial year, all of them up over 30%, I think.
I think you were mentioning to me earlier that it's a Morningstar table, and this is the first time for a long time that you've had those 4 separate asset classes that have all returned over 30% in the last 12 months. Yeah. And I guess I ask you, is there a chance of that repeating? And the answer to that is highly unlikely, but there's even more chance now of a downturn in those markets as a result of that, significant outperformance across the board.
Yeah. And that's one of the key things I think about continuing to look forward rather than back, is you never know what the catalyst is going to be to cause people to decide today's the day they don't want to own whatever assets that they get out of. And those catalysts have been things like a pandemic, it's back the Asian debt crisis, through to the tech wreck, through to the GFC, as you were referring to earlier, misbehaving bankers, etc. You don't know when people are going to wake up and decide that, so you have to have your own view on the world and be disciplined about how you allocate to those assets, because that's where you're going to get the long-term growth from.
Yeah, and everybody's been caught up in the noise at the moment, right? And that's where you do have to be disciplined as an investor. And again, just from a look-forward basis, now is more important than ever to be taking stock with one's investment portfolios, because I implore those out there that did get directional last year and overweight portfolios towards equities have done really well. The last thing you want is you've accumulated that wealth post-pandemic is to lose a substantial amount of it because, greed overtakes, sensible, disciplined behaviour.
And maybe gold was a good example of that, or gold companies was a good example of that through the middle sector of last year into the end of last year, where I think there was a lot of press around gold company owning millionaires getting printed overnight off the back of gold price and re-rated gold stocks, etc. And now gold's back down, and gold stocks in particular are down to where they were a year ago. So it can come and go. You've got to stay true to why you're in something as opposed to trying to jump on the bus.
And probably the greatest example of that in the last 2 years has obviously been our friend cryptocurrency. We took a view on digital assets in February, March last year, not 2021, 2020, before anyone was actually talking about the space. And what we realise is it's a space that we don't necessarily believe in the underlying fundamentals of it, but what we realised in February, March last year is that the institutional market was no longer ignoring the digital assets and crypto space and blockchain technology. And again, we spent our time and did the work required to actually identify who we felt in Australia was best to manage that position. We selected Apollo Capital just down the road from us, from our office here in Cremorne in Richmond, and they've done a stellar job for our investors. And I guess what we saw moving into the start of this year, when Elon Musk is talking about dog faces on coins and that's worth $65 billion. This is hubris behaviour in the market, and it's euphoric. And as a result of that, we've done very well for investors within that space. We've continued to support that space, albeit now through a different strategy within digital assets. But it's again being mindful that yes, that asset class even the last couple of months has continued to strengthen again, but it's not being greedy. It's taking money off the tail, particularly when you've had that sort of outperformance of 4 to 5 times in a very short period.
Yeah.